Hello and welcome to Market Domination. I'm Julie Hyman alongside Jared Blickery today, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here is your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
I think the last couple of days are just evidence to that investors are grappling with these two somewhat opposing forces and trying to get a sense for whether or not we're going to continue to hit highs in the S&P 500 or have to give some back on some profit taking.
Now that you move past earnings season, the market has to now start focusing again on what is the Fed going to do and inflation and each economic data. So that just makes for a more volatile market. Our underlying message is we still think the primary trend is higher. I think near term, the market will be searching for a catalyst, which likely means that we're in more of a choppy period after that 7% rip up.
Things are moving very fast. The political winds have shifted. I mean, over just about a week ago, we didn't think this was going to happen, but everything really changed on Monday. There was a complete 180 as far as we're concerned from DC and the SEC on this topic. We think that they were likely going to deny these things until sometime late last week.
We've got 1 hour to go until the market close as we head into the long holiday weekend. Let's take a look at the major averages here. The Dow just peeking into the red here, down about 4 points, sort of fading as we get toward the close here, as maybe people leave their trading desks to get out of here early for the holiday weekend. Who knows? The S&P 500 pretty steady here, though, up 0.6% on the day. On the week, the S&P is very little change as we see that volatility coming back into the fore that we just heard Keith Lerner refer to in an interview from this morning. The Nasdaq on the week doing much better, though, up 1.3%. And on the day, it's up about 0.9%. So quite a different picture there. Looking across different assets just quickly here, taking a look at the 10-year, still below that 4.5% range, even though some of that higher for longer narrative was coming back to the fore this week. And I want to scroll down and take a look at Bitcoin as well, which we're going to talk about later in the show, on that sort of change in crypto sentiment coming from Washington that affected things this week, up 2.4% today, and on the week, Bitcoin up almost 4%. And then taking a look at some of the sectors and where we're seeing the action in today's session, some weakness in healthcare, a little change in real estate and energy. We've got communication services and utilities doing the best today. And speaking of utilities, by the way, as we see that group up by 1%, I know I've talked a lot about this group lately, but it's because the performance has been so impressive. It's the best performing group year to date, up 13%. And one particular energy stock, power stock, I should say, Vertiv, if you look at its year to date performance, it has now surpassed that of NVIDIA, Jared, which I guess tells you something about what's going on with the enthusiasm for these utility companies.
Yes, it does. And stocks are mixed today following after the Dow is coming off of its worst day of the year. So how do investors make sense of the latest market volatility? We're going to bring in now Dory Wiley. She is the Commerce Street Capital CEO and President. I'm sorry about that. Dory, let me just get your comments about the week that we have seen so far. NVIDIA earnings out, that's in the rearview mirror, but couldn't save the market from a down day overall. We've had some surprisingly hot data over the last 2 days, and that just leads to the conclusion that the Fed may actually have to stay higher for longer. What's your first blush impression of the week?
Well, there's a lot there, but thanks for having me on. First of all, yeah, NVIDIA drives Mag 7. Mag 7 drives the market. So that earnings release was important. And of course, they blew it through the water. That stock's up well over 200% for the year, 2,500% for 5 years. And if there's been a weak spot in the market, it's been big tech over the last 20 years. Now, used to, when I would look at it, I'm a fundamental investor, I'd see Amazon with a 5 or 6% margin, didn't make money. I couldn't understand the valuation. And arguably, I've missed the boat early on. But with NVIDIA, it's easy to look at that from a value standpoint. The company's got 50% margin. They're running 90+% return on equity. They're growing like crazy in the pursuit. Their position in the market is not only super a first mover advantage in the AI space and accelerated computing, but it's already getting entrenched. And so it's a really amazing stock. But I would say the market's got a little more depth to it than just NVIDIA or Mag 7, because if you look around at all the companies reporting in the first quarter, these companies, we had earnings surprise here, right? We did well up over 5%, 5.3% in earnings expectations when the market was expecting, 3.9%. And so that was a nice boost to help some of this downside protection everybody's worried about amidst some other concerns about rate hikes, higher for longer, inflation and stuff, which we can talk about.
Dory, I want to dig a little bit in on NVIDIA and the Mag 7 specifically here for just a second, because I feel like the big question is, after the numbers, should people be thinking about adding to NVIDIA if they don't have a position, or if they don't have a large position? Should they just stay pat? And does that extend to the rest of the Mag 7 as well?
Well, that's probably the biggest question for not only individuals, but institutional investors, right? If you're an index person or you're a large cap manager, do you have the Mag 7 allocation to your portfolio? Do you have the NVIDIA allocation? So about a year ago, I started saying, you underallocate at your own risk, because these stocks have fundamental reasons to keep growing and to keep driving the market and to keep what? Dominating the S&P. So if you underallocate, you're in big trouble. I think that still holds. NVIDIA still looks strong. Microsoft still looks strong. And if you want to outperform the market, then you can tactically overweight some of these stocks that you like more and underweight the Teslas and the whatnot. But you underallocate Mag 7 at your own risk. So you kind of have to be in, and you have to bite the bullet. And I would get this same question back in November and December when the stock was $300 or $400. And I said, you just have to close your eyes and put a little in, and then pray that there's a dip of 10 or 20% to shake out some of the euphoria, and you can get in then. But I think you got to establish a position and then pray for some dips. The joke I had with my trader was, I said, hey, you're supposed to be buying this NVIDIA on dips. This was a few months ago. And he goes, there haven't been any dips. And I said, no, Rick, the dip is when it only goes up 1%.
I like that. You're right, though. The U.S., it's more than just U.S. tech here. And I know that you're also looking at financials, some of the banks. Just tell us maybe some individual names that you like and why you might be favoring the sector overall.
Yeah, so other areas besides big tech, obviously, where else can we participate? In the first quarter, financials and energy did real well. I think fundamentals on energy, just as a sector, still look really good for long-term infrastructure issues, et cetera. Being in oil and gas can be very profitable. Back on the banking sector, the market has taken this position, and then we can get back and talk about the Fed, but the market has taken a position that the banks can't do well unless rates go lower. And that is just not true. Banks can do very well where rates are right now. Now, they're not used to having rates hiked 500 basis points, and that creates some net interest margin pressure, but it's short term. Unless you do something silly and stupid like long-term assets with short-term liabilities, and that got shaken out with some bigger banks in March of 2023. But most banks don't do that. Most of them lend on the short term, borrow on the short term, adjust their margins, and they're fine. The other thing that's already priced into banks, so we've priced in, oh no, higher for longer, so that's bad, which is not true. But what may be true is this factor of, hey, what about credit issues, particularly office space? And everyone's looking for the problems. They're in office space, but they can't figure out who has it. Smaller banks say bigger banks say smaller. They both say regional says CDOs. It's sprinkled in all of them, okay? So you have to do your work on the credit side. But I'll tell you this, it's overpriced to the downside on the fear factor for banks. And there are many banks that have very little office space exposure and actually expanding margins.
Well, Dory,
right now that are screaming buys at lower prices than they were in 2009.
Well, Dory, I want to talk about a couple of them, because when you talk about the market sentiment towards banks, the market sentiment towards large banks seems to be okay, particularly like if you look at the JP Morgan, which is up 18% this year. It's really sort of the mid-sized, the regional banks that have gotten smacked in particular, right? The two banks that you like are, in fact, regional banks. One of them is called Enterprise Financial. It's based in St. Louis and Kansas City. The other, right there at home in Texas, Texas Capital Bank shares. So what stands out about those two, both of whom have underperformed the market this year?
So let's talk about the difference right quick. People have always found safety in bigger banks. Oh, JP Morgan, they're too big to fail. We'll buy them. But that's not for upside. And with the reports we're seeing out right now that deposit costs are getting more and more expensive for the bigger banks, whereas before they had a competitive advantage. And so some of that is actually really good for these community banks. Some of them have a better control on their deposit costs than others. In addition to, most people would be surprised to know that JP Morgan has 6.4% tangible capital. Personally, I'd like to see about 8%. Well, these two banks you just mentioned are running at 9 and 10% tangible capital. So if things get ugly, this is actually a competitive advantage because a bank with large capital amounts, they can go grow in a down market. They get to define the credit terms. They get to pick up the banks on the cheap when they're buying. They can do all kinds of things. The regulators give them a green light because of that capital. So there's this perception that big is bigger, is better, but it's only bigger. And in some cases, they actually have more risk on the balance sheet. I'm not saying JP Morgan is risky. I'm just saying I wouldn't like to see as much leverage in JP Morgan or B of A or in Citi as I do some of these community banks, which are run with a much safer capital level percentage.
Dory, it's always good to catch up with you and get some investing ideas from you. Have a great weekend.
Thank you.
Thanks. Well, we're just getting started here on Market Domination. Coming up, the Securities and Exchange Commission taking the first step toward allowing Ether ETFs to trade. We'll check in on the crypto space on the other side and the changing attitude in Washington toward crypto. And Beyond Meat Burgers may be great on the grill, but is the stock worth adding to your portfolio? Find out in our latest edition of Good Buy or Goodbye. All that and more when Market Domination returns. The Securities and Exchange Commission takes the first step toward allowing Ether ETFs, spot Ether ETFs, to trade. The regulator giving a green light to exchanges to list ETFs that hold Ether, but it's not yet given approval to money managers that want to issue the new funds. So what happens now? Our very own David Hollerith has more. And, you know, we were familiar with this process from when the spot Bitcoin ETFs got approved. But like that was wait, and then it sort of all happened at once. Now we got a holiday weekend in between. So what's the latest here, David?
Yeah, Julia, as you start off saying, it's important to emphasize that these products are not live yet. And it's not clear when they will begin trading. The SEC has to approve the second step, which is essentially applications that the money managers who are issuing the products themselves have filed. Now, typically, when they approve the first step for the exchanges, it's kind of known that they're anticipating the second application. So they usually do come in tandem like last time. Now, being that there is a gap, it is somewhat interesting. This whole situation with the Ether ETFs has been sort of a sudden reversal in terms of what some of the issuers had been hearing. And there's been talk that this could take a couple weeks. This gap has actually been known to take as long as several months. It's expected to be faster. It's kind of expedited because the Bitcoin ETFs had.
All right, we're having some technical difficulties with David, so we're gonna see if we can get him back. But we want to turn our attention now to some trending tickers. Shares of Workday, they are plunging today after the company slashed its forecast of annual revenue. Workday taking other workplace software stocks down with it, and investors now look ahead to Salesforce results out after the close Wednesday for another read on the industry. And Julie, this is just a case of you're either AI or you're not. And this kind of echoed by Bloomberg. Quick quote here: the weaker outlook supports our thesis of a weak environment for non-AI enterprise tech spending.
Yeah, that was really the quote that stuck out to me as well, because when this kind of thing happens, the first question you ask is, okay, is this Workday specific, or is this something bigger that's going on in the industry? It seems like it is perhaps the latter. Now, the company has been trying to undergo a bit of a turnaround under the CEO, who now holds the sole CEO spot, Carl Eschenbach. And analyst commentary seemed to be relatively optimistic that he can do it over the longer term, but they acknowledge that the short term is going to be bumpy. Yeah. In part because of the macro environment. Yeah, and it wasn't all bad. Results were mixed according to RBC, leading to this lowered outlook. But he said on the bright side, operating margins of 25.9%, solidly above consensus. Quick quote by Vital Knowledge: investors will focus on the subscription revenue outlook cut, even though if it's modest, or even though it is modest. And that's really what got investors' attention. But if we can go to the Wi-Fi Interactive here, I do want to show our heat map, and you can see Workday. This is today's results. Workday down at the bottom, down 15%. Here is a year to date, and just kind of illustrates the have and have-nots, where you have the top row, the green, and even that's not great when you compare it to the chip stocks. But you look at the bottom row, Twilio down 22%, VRM down to 78%, Teladoc in there. So it's been kind of a rough patch for software this year. Yeah, it certainly has been. That's good perspective to have there. And I feel like Nutanix is getting bought. So that's the reason that one is up so much. Let's look at a very different industry. The shoe business. Well, shoe business. The shares of techers are surging today, trading above $1,000. Forget about Nvidia. This stock's trading above $1,000.
They need to do a split.
It's touching record highs, and it comes after the company projected 10% revenue growth for the year ahead. The stock, by the way, is up more than 50% year to date, and you can see with that bump up again today. This all has to do with the popularity of a couple of its shoe brands, in particular Uggs, which saw a big increase last quarter in the numbers, 15% increase in those net sales. And then the other hot brand has been Hoka, which is now the biggest part of its business by revenue. That saw a 34% increase. I do have some quotes here, some analyst quotes. We have Raymond James rating the stock and outperform. Deckers had a masterclass in beating expectations. That reads strong. Another beat across EPS, revenue growth margin, and EBIT. We viewed the fourth quarter guide as conservative, but are surprised at the magnitude of the upside, especially for UGG, which had lean inventories. Raised the price target to $1,100 from $925. And Cowen saying the expectations were just crushed. So just
kind of a blowout. I'll chart this real quick on the Wi-Fi Interactive. And as you said, up over 50% on the year. And just to give you a 5-year look throughout the pandemic, that's an impressive chart. A lot of pandemic darlings kind of went like this, and they just didn't come back.
Yeah, and we're seeing some of the other retail stocks also get a pop today. Crocs, we noticed, was higher. Ross, which also, by the reported this week, was also trading higher. My big question about Hoka's and that whole trend that we've seen is a lot of other shoe companies have copied the sort of maximalist shoe, the very big foam cushion. So you wonder if Hoka itself will be able to hang on to its market share. We shall see. Well, on June 13th, Tesla shareholders will have another chance to vote on CEO Elon Musk's pay package that's been worth as much as $56 billion. The compensation, remember, was invalidated by a Delaware judge earlier this year. But Musk is not the only company leader who's been pushing compensation packages higher. Yahoo Finance's Alexis Keenan has the details. Hi, Alexis.
Hi, Julie. So yeah, if you look at CEO pay, it's on the rise. If you look at the Russell 3000, kind of a broad look at CEO awards in the 5-year period that came right after that Musk pay package. So from 2018 to 2022, you have among all CEOs in that index up 6.2%. If you look at CEOs that are running companies with revenues exceeding 20 billion, that's more modest, 2.4%. But then the big whopping number are for those CEOs and companies with that less than 50 million in annual revenue mark at 19.3%. So how do you put this all in perspective with that Musk pay package, given that he didn't have really these annual awards? He had that big 2018 $56 billion package, as we now know in hindsight. So if you try to compare, you can look at, let's say, the highest paid CEOs of 2023. In that case, Broadcom's Hot Tan. He was awarded $162 million, mostly in stock awards that vested over 5 years. You have then Palo Alto's Networks' Nikesh Arora coming in second place, awarded $151 million, plus some performance-based stock options there. You could also take a look at CEO pay at the largest U.S. companies. So let's say companies that have revenues for annual revenues exceeding $1 billion. There, you have the median in 2022, up 7.7% over the prior year. You jump over to 2023, up 11.4% over 2022. So under Musk's deal, that had a 10-year period. So he had to try to meet these performance goals that are in that package over 10 years. Now, that was pairing revenue marks, profit marks, market cap requirements, all these milestones. And if he hit them, it opened up these 12 different buckets of stock options. And that is worth approximately, give or take, about 1% of Tesla's equity. But had that been spread over 10 years, let's say, and we know it's not because he already achieved these benchmarks, that would still be approximately $5.6 billion a year. So you can kind of put that up against those other numbers that I showed you for those annual awards to try to get some sense of it. So then you have on top of that Musk owning approximately 22% of the company, all things considered. His pay, if you break it down on that 10-year basis, still really in the stratosphere. Guys.
Big numbers, Alexis, and we're going to keep talking about this. A group of Tesla shareholders are trying to encourage others to vote against CEO Elon Musk's $56 billion pay package. The group that consists of Amalgamated Bank, SOC Investment Group, and 6 other signatories, they say Musk is distracted by all the other companies he is running. Writing in a note to shareholders, quote, Tesla is suffering from a material governance failure which requires our urgent attention and action. Joining us now is one of the letter's signatories, Brad Lander, the New York City comptroller. And Brad, thank you for joining us here today. A big pay package for Elon Musk. You take this away, it's going to make a big difference in the world's richest person's fortunes here. Why did you sign this letter?
Well, first, thank you for that reporting. You just heard that, even amongst the largest companies, 23 million a year, this, even if you average it over a decade, $5.6 billion stratospheric pay. But really, the bigger problem is lack of independent board governance. That's why the Delaware Chancery Court invalidated the pay package. The board is supposed to be independent. The board is not independent. Shareholders did not have a meaningfully independent say on pay. We have a corporate governance problem at Tesla. It is acting like a family-owned business when it's a publicly traded business.
What do you make of Musk's sort of either hinting or outright saying that if this doesn't get approved, he's going to spend less time on Tesla than he does now, and that perhaps some of the AI initiatives he's working on, he'll take to some of his other companies.
Look, I'd like to see a CEO at Tesla that is focused on Tesla, and that's not what we have. We have a CEO that's focused on SpaceX, that's focused on X, that seems to be focused on random politics. What shareholders of Tesla want is for the board to make sure that the CEO of Tesla is focused on Tesla, thinking about how we grow and expand EVs and make money for shareholders by running Tesla. And that's not what we're getting right now. So if Trump, excuse me, Freudian slip, if Musk's threat to Tesla shareholders is pay me $56 billion or I'll stop being a distracted CEO for your company. Let's have the board say what we want is a CEO who is focused on helping Tesla succeed.
Brad, what do you think your odds of success are? Elon Musk has been counted down and out in various situations over the years, over the decades, and he's bounced back pretty strong and pulled some rabbits out of the hat there. What do you think the odds of winning here are?
Well, look, I'll say this is not about, if Elon Musk wants to focus on Tesla, have an appropriate compensation package and a board that provides appropriate shareholder governance, just like shareholder capitalism provides for, that would be fine. What our odds are of winning on the package, look, a lot of the stock is held by non-independent shareholders. So these are hard votes to win, but it is important for shareholders who believe in independent shareholder governance to raise their voice when there is not legitimate independence. And let's be clear, it's very rare for a court to say that a corporate board failed to act with required independence. That should be a wake-up call to Tesla shareholders, and I hope they'll join us in the vote.
So New York and the funds that you oversee, the pension funds that are in your purview, have about 3.4 million shares of Tesla. So we're talking about a stake worth over $600 million. So one would think you would have some clout here. Is there a circumstance in which you would sell? What would it take for you to say, all right, enough is enough? Or, do you have other sort of levers you can pull besides writing a letter?
Well, it's more than writing a letter. We're voting. We're trying to lead a vote of shareholders against this $56 billion executive compensation package that has already been overturned by the court. That's what we're focused on right now. We're trying to get other shareholders to say this is a moment for independent shareholder governance. Here's how we can send a strong message. So that's what I'm focused on for right now. I hope other shareholders will join us in that vote, and we'll see what happens afterwards.
Brad, any other companies you have your eyes set on? You're in the position, you have the ability to be kind of an activist investor here. Anyone besides Tesla?
Well, we've been focusing on some other companies recently. We focused recently at Exxon, where they were also essentially taking legal action against their own shareholders, trying to call attention to that and getting shareholders to vote against the management recommendation. We didn't do that well at BlackRock, but we urged BlackRock shareholders not to vote for the Saudi Aramco CEO to be on the board. That is not consistent with BlackRock's decarbonization commitments or the climate transition that we need. But I will say we had some great partnership wins earlier this year when JP Morgan Chase and Citi and Royal Bank of Canada agreed to move to asset financing ratios for clean energy. So shareholder engagement is a great way to make progress. Sometimes we make it, as we did at Chase, Citi, and RBC. Sometimes we come up short, as we did in the most recent float at BlackRock. Hopefully at Tesla, we can help move in the right direction.
All right, we're going to leave it there, but I really appreciate you stopping by here on a Friday afternoon ahead of the Memorial Day weekend.
Hope you have a great holiday. Thanks for having me on.
Hot dogs, burgers, and potato chips are must-haves at any Memorial Day barbecue. Speaking of, but do they all belong in your portfolio? Find out next in our latest edition of Goodbye or Goodbye.
It's a big, noisy universe of stocks out there. Welcome to Goodbye or Goodbye. Our goal to help cut through that noise to navigate the best moves for your portfolio. Today, it's all about your Memorial Day barbecue. Burgers and potato chips may taste great on your plate, but they're not created equal when it comes to stock gains. So what's the best way to play it? I'm here with John Baumgartner, Managing Director and Senior Consumer Equity Research Analyst at Mizuho. Good to see you. Thanks for being here. So in this case, chips win the day. UTS is your pick here. And if you look at the stock, it's up on the year, but it's had sort of a little bit of a rocky time. First of all, you say generally salty snacks are doing well right now?
That's correct. I mean, you're seeing a little softness in the category. Volumes are flat to down less than 1%, but compare it relative to chocolate candy, sweet baked goods with volumes down mid to high single digits. And on top of that, those sweet categories should see more price inflation this year from cocoa, sugar. You'll see prices moving higher most likely, and that should even reinforce the position for salty snacks.
Do you have a favorite UTS product?
Chips.
I, as a Marylander, the crab chips, the UTS crab chips are the way to go. Gaining market share as well. So UTS, obviously it's a big category. There are a lot of players here. How is it doing well against its competitors?
Well, when you think about the UTS geographic exposure, almost 2/3 of sales are from core markets, East Coast, New England, Mid-Atlantic. There's an expansion territory now, almost 40% of sales, west of the Mississippi, central, southern U.S., expanding out through M&A acquisitions, getting on shelf, getting more distribution. We're seeing distribution right now for UTS mid-single digits, 5 or 6%, helping drive sales as well.
Interesting. And then there's also some restructuring that's going on here. So what does that look like and what is it doing for the company?
Right, so UTS has laid out a 3-year plan of about 300 basis points of margin expansion. That involves shuttering lower efficiency factories, investing in AI analytics, better returns on trade promotion.
Oh, I gotta stop you right there. How does a chip company use AI?
A number of different ways, right from the manufacturing assets themselves, listening to vibrations on the machines, knowing in advance when they may break down, so you can either accelerate maintenance or defer it if you don't need it. That's number one. Number two, giving much better insights in trade promotion, getting better lifts on volume, knowing in this geography there's more of a pull for buy one get one or buy two get one, so you're getting better lifts on promo.
Very cool. Because I hear everybody talking about AI all the time, so it's good to know specifically how it's being used.
Yeah, I mean, we even see food companies just using listening tools on the internet, hearing what flavor combinations are popular, and using that to inform innovation going forward too.
Very interesting. Okay, so the thing that could potentially go wrong for UTS here is more a bigger picture issue. It wouldn't be an UTS specific issue.
That's right. I mean, this quarter we heard a fair amount of concern for low-income consumers. I mean, UTS's portfolio skews more towards mainstream households to begin with, but it is a concern for the category, and with lower volumes comes more price competition. In salty snacks, we haven't really seen price competition since the financial crisis in the past 15 years. It's a pretty rational category. We think that demand holds up. Again, even sweet snacks are even weaker at the margin, so we think you could see more consumption coming from sweet into salty this year, and the share gains by UTS with new distribution also should reinforce sales for them.
Are we continuing to see pricing go higher when it comes to this category?
It's flattened out now for the most part. I mean, you've typically seen low single-digit pricing historically. The product mix is another lever as well. Changing pack sizes, more single-serve packs. Soft drinks have done a very good job of that over the years. Salty snacks moving towards that approach as well. So pack size is a big benefit. We don't have to necessarily raise the list price increase. Smaller pack size, higher price per pound, that gets the job done as well.
Gotcha. All right, so let's talk about the stock that you would avoid here, and it's in the burger category, specifically the plant-based meat category. It's Beyond Meat. The stock is already down a lot, but you're not nibbling here, so to speak. And there's demand weakness we've been seeing this for a while.
Yeah, I mean, category volume has been down for 40 straight months now through April, and that's more or less priced in. But our concern at the margin is strategy and competition. If you look at strategy in 2023, when the industry took prices up during inflation, Beyond took prices down. Now they're raising prices into a down market. We're seeing pricing on the shelf now up 10% year on year already in April. Price increases went through last month. We're very concerned over larger elasticity, another leg down for volume for Beyond Meat. I mean, back in 2020, their market share was north of 20%. Now it's down to about 14 to 15. We see more downside risk there, and that's compounded by competition.
Yeah,
we're seeing Impossible Foods, really, I think, revitalizing their business. Relaunch in effect now. launching new flavors, some spicy varieties that are out there, getting more distribution, plant-based chicken into Whole Foods now, as of this month. So we think that combination of higher prices for Beyond, more elasticity, more competition from Impossible, we see downside to revenue this year.
All right, and then let's talk about what they might need to do on the capital side, that there might be some sort of capital raise that would dilute equity.
That's right. Cash burn here is still very strong. I mean, we model about $100 million of cash burn this year, down from $120 million last year. So it's an improvement year on year, but with $160 million on the balance sheet at the end of Q1, that burns pretty quick. So, our sense is they will have to do some sort of a capital raise this year. At a $6, $7 stock price, it could get really dilutive really quickly with 65 million shares outstanding.
So what could go right for Beyond Meat? And I guess new stuff that's going to get people to buy?
New stuff. You see the launch of Beyond version 4.0 with avocado oil. The company has received some accolades from the American Heart Association, American Diabetic Association, with the avocado oil as an ingredient, reducing saturated fat, reducing sodium. That's rolling out into the market for this spring and this summer. That could drive a bit, a recovery in market share, stronger sales from here for the duration of 2024. International, they have been growing internationally with distribution, especially in food service with McDonald's over in Europe. That could be a positive as well.
Any position in either of these stocks?
No.
Okay, just had to ask. All right, so you say people should buy us, avoid Beyond Meat. Very appropriate going into this holiday weekend. Thanks a lot, John. Good to see you. Thanks so much for watching Goodbye or Goodbye. We'll be bringing you new episodes 3 times a week at 3:30 p.m. Eastern.
We're going to take now a look at Lionsgate. The shares are sliding despite a beat on the top and bottom lines for the fourth quarter. The results come after the launch of Lionsgate Studios as a publicly traded company earlier this month. Now, Lionsgate also preparing for the full separation of its studio and Starz businesses. And Julie, just in reference to these results, Bloomberg Intelligence saying Lionsgate is going to look to build on its solid finish to the fiscal 2024 with the spinoff of that pure play content company. We know that. Cowen saying the results are better than expected, helped by a strong studio performance, and then saying about the separation there, the separation of Starz and the studio businesses should be completed by the end of the calendar year this year, but remains unclear as to how the company can create a separate equity for Starz while the market values it incorrectly, in our view, at near zero. So
yeah,
unlock near zero value.
It's not obvious why these shares are going down because, as you said, the numbers did look pretty good. The only thing that maybe makes sense is that there is a little bit confusion about what this company is going to look like after this, right? Already you have the Lionsgate Studios piece trading on its own, but we don't know what the future of the Starz business and the TV business is. I was just looking at the results by unit here, by segment. The studio business said revenue went up 6.8%. Profit went up as well, but motion picture segment revenue was down by 23% and profit fell as well. Television production revenue was up 61% and media networks domestic revenue was up on a sequential basis as well. So in other words, it's very uneven among these different segments, and so maybe people are just having trouble getting their hands around it.
It's also a media stock, and you have separation of shares within Lionsgate. You have the A and B shares, and that sometimes causes some arbitrage opportunities. Strange things have happened with News Corp that I've seen in the past. I wouldn't be surprised if there's some stuff behind the scenes that maybe we don't know about going on here too.
Yeah, that makes sense. That's a good observation. Let's talk about Petco shares getting a lift. The pet health and wellness company posting a better than expected first quarter. Petco also expecting to be free cash flow positive for fiscal 2024. But what's interesting here is the company came out with this earnings report on Wednesday, and the shares just keep going up here. They're now up by about 12% year to date, and there is still a relatively high short interest in this company as a percentage of float, but it has gone down. According to S3 Partners, it's about 12% of float right now, but that might be partly responsible for this continued squeeze higher.
Yes, and we've seen a number of stocks that have gotten crushed over the last few years really exhibit some strength. There's the meme phenomenon, and Wolf arguably could be considered maybe one of a meme-ish stock. If we go to the Wi-Fi Interactive, I'll show you what happened year to date. And here you can see with today, they finally climb into the green. I'll show you a line chart. You can see it a little bit better. When I put a max chart on, though, you can see still down 86%. And that's why I'm saying after this rout here, what happens, if there's a 50, 100% rally after a 90% drop while you're still about 80% down, something along those lines. I do have some commentary here. This is from Evercore. Petco's first quarter results easily topped these muted expectations, but the real treat, got that? Real treat was management's expectations for positive free cash flow in 2024. And so for a stock that's been beaten down and arguably has a harder time with higher interest rates, which is what we're talking about, that positive free cash flow means a lot.
Yes, and it means a lot to the stock price today, seemingly, as well. Well, coming up with the latest market whiplash, we're looking at how to navigate the big picture with the Yahoo Finance playbook. That's on the other side when market domination comes back.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs?
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Markets hitting a speed bump recently following multiple up weeks for all major averages. The Dow Jones Industrial Average looking to bounce back from its worst day of 2024, but it's a little changed right now. With the market whiplash, we're looking at how to navigate the big picture with the Yahoo Finance playbook. Pernas researcher, co-founder Dea Pernas, along with Mahoney Asset Management CEO Ken Mahoney, are joining us now to discuss. Thank you guys so much for being here. Dea, I want to start with you here. How should people sort of think we're sort of up and to the right for a while pretty consistently, and lately things have gotten a little bit more volatile, especially now that the catalyst of earnings season is over. What's going to be the next catalyst, and which way is it going to take us?
Yeah, I think that as far as the recent volatility, I think it should just be put in perspective. If you look at just broader sentiment, if you're looking at pricing volatility like the VIX for the index, that's still quite near 10-year lows. So if you zoom out a little bit, the volatility is still quite low. And the market is actually, when you're looking at that broader perspective, quite complacent. So I think that if there's any sort of risk, it's a risk of complacency. The broader index, if you look at investment grade spreads, if you look at high yield spreads, all of those are near 10-year lows. So from my perspective, at the index level, there's been a complete departure of recessionary fears from broader market pricing. And if there's anything investors should be worried about, it's complacency at the index level.
Dea, we have the indices at or near record highs. Well, we just had a big sell-off, but they're still pretty close within a few percentage points. Do you think the markets have gotten too complacent here? Well, how are you viewing things?
Yeah, I think, look, the market's trading at 21 times forward, and it's somewhat typical of late cycle that you see large cap quality do quite well, and that's what we've seen this year. And if you drill down into some of the smaller cap names, the small cap index right now is small cap value is flat on the year. Small cap growth is up a little bit on the year. So the other smaller type names have not participated. And if you drill down into different subsectors like quick service restaurants, like luxury goods, like staffing companies, like real estate related sectors, a lot of those are struggling. So if you look at it holistically, there's some areas of the market where cracks are evident. But again, at the index level, I think there's a lot of complacency. So I think investors should take a more holistic view and realize that, look, maybe large cap's done really well. Maybe I should rotate in some of the other, different type sectors. Maybe some of the traditionally lower quality stuff, because there is some value there.
Well, Dave, we'll get back to you on what some of those specific ideas are, but I want to get Ken's take on this idea of complacency, and specifically, Ken, through the lens of valuation, which I know is something you've been doing some work on.
Right. So first, again, it kind of sounds like a cliche, but seriously, we went from April showers to May flowers. And, the Bears really had a good opportunity. I mean, really was the perfect storm, Russell Crowe movie, where, you had higher interest rates, you had the Federal Reserve nonstop, higher for longer. Oh, missiles flying around in the Middle East. And the Bears only got, about 5-6%. And the bulls took over again. I think the reason why it's happening is we're getting a very strong tailwind with earnings and earning estimates going higher. We saw what happened this week, one example in the video, but there's a lot of examples this earnings season, especially in technology. So we don't need to be near airlines and autos or retailers or some of these other ones that are mentioned. We don't need to be in those industries. We're in the fast lane. We're growth managers. We accept a bumpier ride in the left lane. But that's where all the CapEx spending, that's where the excitement is. The multiples can expand when we have this type of opportunity. And I know there's a lot of similarities with the 1990s and stuff. But that was like eyeballs and clicks on valuations. These are real contracts. These are real $20 billion contracts with Meta or $20 billion contracts with Tesla. So to me, you can actually justify the valuations when you have top line growth like this, and you still have a 2 or 3 year window for CapEx spending.
Dale, let's go back to you. Just a couple picks here. If you love big tech, we can talk about that. But if you have other areas of the market, we'd love to hear that too.
Yeah, look, I think the best portfolio has a little bit of everything. There's no reason to let dogma take over and focus only on one part of the market and have blinders on. There are large cap quality names that we really like. Ken, he mentioned Meta and some of the huge spend that's going into GPUs and the data center infrastructure that surrounds them. And I think there's incredibly rational reasons to be bullish there. But as far as we try to look at different areas of the market where there is value. And right now, where we are seeing value is some of these smaller cap names that have a little bit more debt, that have variable rate debt, and they don't have quite all the levers that the large cap companies have to pull in order to smooth out earnings through a cyclical type environment. So I think that if you're looking at some of the small cap names, there could be opportunity. I know We're bullish on several that I can discuss, but yeah, that's where we're at with our portfolio.
And what about you, Ken? I mean, you said you're a growth guy. Where are you seeing the best potential for growth right now?
Look, we still see with NVIDIA. I mean, they really haven't come out with a blockbuster helmet that's going to come out later this year. And look, I hear how expensive it is, but again, a lot of that's PE, which is rear view mirror. Forward PE, which is looking ahead, you're finding yourself 37 to 40 for NVIDIA. And quite frankly, that's where it's historically last 10 years. Sometimes it goes higher, sometimes it goes lower with great earnings. What's expensive to us is companies like Nike that have forward PEs of 35, who are going to have 1 to 3% top line growth. Again, we also like Meta. We also like Apple. We think it's going to be a huge upgrade cycle with AI. Also, they're buying back $110 billion worth of shares. That gives some type of support. Microsoft, all the verticals you get, and AI on top of a cloud. And Amazon, obviously, that was kind of a sleeper this quarter. Those are really strong earnings, particularly in advertising. I don't think a lot of people put attention to that. I think for Amazon, it's mostly about cloud. It's the retail side, we trip over your boxes and Prime members, but $12.8 billion in a quarter for advertising. That's very expensive real estate on their site. So again, we still like the big tech. We like these companies because, let's face it, Meta has 3 billion, Facebook has 3 billion daily users, Microsoft 1.2 billion clients, and for Apple, 2.2 billion devices. So we don't like small cap, we like large cap because they have wide moats. And again, little $5 here, $10 here for an upgrade is substantial to the bottom line for those companies that have these huge amount of customers.
Well, you do $3 billion times a couple of dollars, you got a lot of $1 billion. Dea, I want to get to something you're talking about in your notes. A lot of these pandemic companies really took a beating. I'm sorry, pandemic darling companies took a beating in 2022, along with the general market. They've either had trouble raising cash or they've just been kind of thrown out, as you say, baby with the bathwater. Can some of these companies be rehabbed? What would that look like?
Yeah, as you alluded to, there so many companies came public in 2020, 2021, or even early 2022, and it was just a huge money grab. There's a lot of euphoria. IPOs were being priced very extremely, and business owners were accelerating their time to market. And what that resulted in is companies that didn't quite have the full-fledged communication departments, even the full-throated business models that the street typically likes to see for publicly traded companies. And their earnings are just way too cyclical. They're not linked. Like Wall Street really likes to see companies that are growing revenue very steadily year over year, even quarter over quarter. So that's what Wall Street really likes to see. These companies, they're just too small and even a bit too flimsy, but that doesn't mean they're not real companies. I'll make a concession. A lot of them aren't, and a lot of them shouldn't be publicly traded companies. But they are some, I think, jewels in there. And one of them that we really like is Remitly, that went public in 2021. They're a cross-border digital remittance provider. We think there's well over 100% upside from these levels, best-in-class technology. And the company just doesn't quite know how to digest their business model. And they're still acting like they're a private company themselves. They don't communicate the right information with the street. And so there's still a lot of work to be done there. But it's a real business with a real business model.
All right, we're going to have to leave it there. We got the closing bell coming up. Dea and Ken, thank you both for your time. Thank you. And while we are wrapping up today's market domination, do not go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it's market domination overtime. Let's get you up to speed on the action from today's session. So if you look at the major averages here, all of them finishing in the green, although I guess we'll wait for things to settle out. The Dow, it's really kind of a photo finish there, up just 4 points on the day. The S&P 500 up 0.7%. The Nasdaq, the winner here, and the winner of the week for that matter, up 1.1%, helped in part by those results from NVIDIA and the momentum that we've seen in technology. And Jared, it has been an interesting week, right?
Yes.
Because we thought, NVIDIA was the event of the week, but it really didn't
There's so much more.
It didn't really have much of a ripple effect as much as people might have anticipated.
Well, I think the big thing for me was that NVIDIA was not enough to buoy the overall market. We saw the S&P 500 put in a nasty red candle. The Dow was terrible. Now it's a Boeing story, but you also saw Goldman Sachs and Salesforce. So are there some underlying currents in the market? The market was reacting to some economic data that came in hotter than expected. So arguably, the economic data was kind of front seat and NVIDIA was a bit of a backseat. But, they cleared the hurdle. So I think that was a big thing.
Exactly. And I know you're looking at some of the groups here and what we saw for the week with energy.
Energy did bad on the Wi-Fi Interactive. Energy down 3.8%. So is real estate, a very similar amount. And then tech and communication services, the only spot of green there.
And by the way, just heard that the Nasdaq closed at a record again. So it explains there that you've got those two groups that are the most heavily weighted in the Nasdaq that are doing the best.
Yes.
Yeah.
Agreed.
All right, let's get to that more on that stock split.
You bet. NVIDIA this week announcing a 10-for-1 stock split. It's the 8th stock split announced by a company so far this year, and historically these moves have been bullish for the companies that announce them. Analysis by Bank of America showed that on average, companies announced a stock split. They outperformed the S&P 500 index in the following year, and it's not by a little, it's by a lot.
Yeah.
And I was thinking about this. Why would this be? And they break it down by decade. So it doesn't matter which decade you look at here. Stock splits tend to be good for performance. Why would that be, though? Maybe because that's a good problem to have. If you have to have a stock split, that's because you've been doing well in your stock. The price has gotten a little bit out of range for the everyday ordinary investor. So I think it's just the cohort, the group, lends itself to that.
Well, I find this such a fascinating phenomenon because theoretically, I can today buy 1/10 of a share of NVIDIA, for example, or 1/4 of a share of NVIDIA.
Yes.
But there's just something psychologically about owning one share. And obviously there's an affordability difference between having a stock that is worth $100 a share and one that I have to pay $1,000 a share for. So you see sort of the psychological importance of it. What's interesting to me is that number is pushed up by the average quite a bit because 30% of the time stocks after they split are down 12 months after. So, it's still the majority of the time and the majority of the stocks that experience an increase. But there is a substantial minority that does have declines. The other interesting thing that Bank of America looked at is that there's been over time a dip in the number of splits, but recently there's been a little bit of a resurgence, and they pinpoint 36 companies in the S&P 500 that are above $500 a share. So maybe they would be the next up that are potentially eligible for something like this.
And not only that, there's the side bet that if a big company that's getting a lot of headlines splits its stocks, maybe it's going to join the Dow, something along that line. That's not the case here. We've heard no inklings of that, but there's a lot of speculation.
Right, because the Dow is a price-weighted average. The folks who put it together don't want to put a very high-price stock in there because it'll really skew the Dow
Apple,
overall.
Before it was admitted to the Dow, they did a stock split. So that's where that comes from.
So we'll see if it ends up happening with NVIDIA. Well, speaking of NVIDIA, as it prepares for its 10-for-1 stock split, an announcement arriving alongside its blockbuster earnings report, Yahoo Finance's Dan Howley and myself, we had the chance to speak with CEO Jensen Huang, covering all things AI and what is next for the chip giant. I'm Julie Hyman, host of Yahoo Finance's Market Domination, here with our tech editor, Dan Howley. NVIDIA has done it again, the chip giant blowing past analyst expectations in its strong fiscal first quarter. Data center revenue alone soaring by 427% year over year. And the company also gave another bullish sales forecast, which shows that AI spending momentum continues apace. On top of all that, the company also announced a 10-for-1 forward stock split. and raised its dividend. Joining us now, NVIDIA founder and CEO Jensen Huang, fresh off the conference call. Jensen, welcome. Thank you so much for being with us.
I'm happy to be here. Nice to see you guys.
You too. I want to start with Blackwell, which is your next generation chip. It's shipping this year, you said on the call. You also said on the call, we will see a lot of Blackwell revenue this year. So if we're looking at about $28 billion in revenue in the current quarter, and Blackwell is a more expensive product than Hopper, the chip series out now, what does that imply about revenue in the fourth quarter and for the full year?
Well, it should be significant. Yeah, Blackwell, and as you know, we guide one quarter at a time. And but what I could tell you about Blackwell is this. This is a giant leap in AI, and it was designed for trillion parameter AI models. And this is, as you know, we're already at 2 trillion parameters. Model sizes are growing, about doubling every 6 months. And the amount of processing between the size of the model, the amount of data is growing 4 times. And so the ability for these data centers to keep up with these large models really depends on the technology that we bring to them. And so the Blackwell is designed also for incredibly fast inferencing. And inference used to be about recognition of things, but now inferencing, as you know, is about generation of information, generative AI. And so whenever you're talking to ChatGPT and it's generating information for you or drawing a picture for you or recognizing something and then drawing something for you, that generation is a brand new inferencing technology, is really, really complicated and requires a lot of performance. And so Blackwell is designed for large models, for generative AI, and we designed it to fit into any data center. And so it's air-cooled, liquid-cooled, x86, or this new revolutionary processor we designed called Grace Blackwell Superchip. And then, supports InfiniBand data centers like we used to, but we also now support a brand new type of data center, Ethernet. We're going to bring AI to Ethernet data centers. So the number of ways that you could deploy Blackwell is way, way higher than Hopper generation. So I'm excited about that.
I want to talk about the inferencing, Jensen. Some analysts have brought up the idea that as we move over towards inferencing from the training, that there may be some in-house companies, processors from companies, those made from Microsoft, Google, Amazon, may be more suited for the actual inferencing. I guess, how does that impact NVIDIA then?
Well, inferencing used to be easy. When people started talking about inference, generative AI didn't exist. And now generative AI is of course, is about prediction, but it's about prediction of the next token or prediction of the next pixel or prediction of the next frame. And all of that is complicated. And generative AI is also used for understanding in order to generate the content properly, you have to understand the context and what is called memory. And so now the memory size is incredibly large, and you have to have context memory. You have to be able to generate the next token really, really fast. It takes a whole lot of tokens to make an image, takes a ton of tokens to make a video, and takes a lot of tokens to be able to reason about a particular task so that it can make a plan. And so the generative AI era really made inference 1,000,000 times more complicated. And as you know, the number of chips that were intended for inference kind of fell by the wayside, and now people are talking about building new chips. The versatility of NVIDIA's architecture makes it possible for people to continue to innovate and create these amazing new AIs, and then now Blackwell's coming.
So in other words, you think you still have a competitive advantage even as the market sort of shifts to inferencing?
We have a great position in inference because inference is just a really complicated problem. And the software stack is complicated. The type of models that people use is complicated. There's so many different types. It's just going to be a giant market opportunity for us. The vast majority of the world's inferencing today, as people are experiencing in their data centers and on the web, vast majority of the inferencing today is done on NVIDIA. And so I expect that to continue.
You said on the call a couple of times that you'll be supply constrained for both Hopper and then Blackwell chips well until next year because of the vast demand that's out there. What can you do about that? Are there any sort of levers you can pull to help increase supply?
Copper demand grew throughout this quarter after we announced Blackwell. And so that kind of tells you how much demand there is out there. People want to deploy these data centers right now. They want to put our GPUs to work right now and start making money and start saving money. And so that demand is just so strong. It's really important to take a step back and realize that what we build is not a GPU chip. We call it Blackwell and we call it GPU, but we're really building AI factories. These AI factories have CPUs and GPUs and really complicated memory. The systems are really complicated. It's connected by NVLink. There's an NVLink switch. There's InfiniBand switches, InfiniBand NICs, and then now we have Ethernet switches and Ethernet NICs. And all of this connected together with this incredibly complicated spine called NVLink. And then the amount of software that it takes to build all this and run all this is incredible. And so these AI factories are essentially what we build. We build it as a holistic unit, as a holistic architecture and platform, but then we disaggregate it so that our partners could take it and put it into data centers of any kind. And every single cloud has slightly different architectures and different stacks, and our stacks and our architecture can now deeply integrate into theirs, but everybody's a little different. So we build it as an AI factory. We then disaggregate it so that everybody can have AI factories. This is just an incredible thing, and we do this at very high volume. It's just very, very hard to do. And so every component, every part of our data center is the most complex computer the world's ever made, and so it's sensible that almost everything is constrained.
Jensen, I want to ask about the cloud providers versus the other industries that you said are getting into the generative AI game or getting NVIDIA chips. You had mentioned that in comments in the actual release, and then we heard from CFO Colette Kress that 40%, mid 40% of data center revenue comes from those cloud providers. As we start to see these other industries open up, what does that mean for NVIDIA? Will the cloud providers kind of shrink, I guess, their share, and then will these other industries pick up where those cloud providers were?
I expect them both to grow. A couple of different areas, of course. The consumer internet service providers. This last quarter, of course, big stories from Meta. The incredible scale that Mark is investing in. Llama 2 was a breakthrough. Llama 3 was even more amazing. They're creating models that are activating large language model and generative AI work all over the world. And so the work that Meta is doing is really, really important. You also saw Elon talking about the incredible infrastructure that he's building. And one of the things that's really revolutionary about the version 12 of Tesla's full self-driving is that it's an end-to-end generative model. And it learns from watching videos, surround video, and it learns about how to drive end-to-end and using generative AI predict the path and the how to steer how to understand and how to steer the car. And so the technology is really revolutionary, and the work that they're doing is incredible. So I gave you two examples. A startup company that we work with called Recursion has built up a supercomputer for generating molecules, understanding proteins and generating molecules for drug discovery. The list goes on. I mean, we can go on all afternoon, and just so many different areas of people who are now recognizing that we now have software and AI model that can understand and learn almost any language. The language of English, of course, but the language of images and video and chemicals and protein and even physics, and to be able to generate almost anything. And so it's basically like machine translation. And that capability is now being deployed at scale in so many different industries.
Jensen, just one more quick last question. I'm glad you talked about the auto business and what you're seeing there. You mentioned that automotive is now the largest enterprise vertical within data center. You talked about the Tesla business, but what is that all about? Is it self-driving among other automakers too? Are there other functions that automakers are using within data center? Help us understand that a little bit better.
Well, Tesla is far ahead in self-driving cars. But every single car someday will have to have autonomous capability. It's safer, it's more convenient, it's more fun to drive. And in order to do that, it is now very well known, very well understood, that learning from video directly is the most effective way to train these models. We used to train based on images that are labeled. We would say, this is a car, this is a car, this is a sign, this is a road, and we would label that manually. It's incredible. And now we just put video right into the car and let the car figure it out by itself. And this technology is very similar to the technology of large language models, but it requires just an enormous training facility. And the reason for that is because the data rate of video, the amount of data of video is so high. Well, the same approach that's used for learning physics, the physical world, from videos that is used for self-driving cars is essentially the same AI technology used for grounding large language models to understand the world of physics. So technologies that are like Sora, which is just incredible, and other technologies, VO from Google, incredible. The ability to generate video that makes sense, that are conditioned by human prompt, that needs to learn from video. And so the next generation of AIs need to be grounded in physical AI, needs to understand the physical world. And the best way to teach these AIs how the physical world behaves is through video, just watching tons and tons and tons of video. And so the combination of this multimodality training capability is going to really require a lot of computing demand in the years to come.
Jensen, as always, super cool stuff and great to be able to talk to you. Dan and I really appreciate it. Jensen Huang, everybody, founder and CEO of NVIDIA.
Great to see you guys. Thank you.
Memorial Day weekend is here, and the unofficial start of the summer usually brings with it a lower volume in the markets. And despite markets hitting records this week, there are overhangs, higher for longer rates, and a looming presidential election. And according to a new survey from Charles Schwab, traders are feeling less bullish. Joining us now is Joe Mazzola. He's the head of trading and derivatives specialist at Charles Schwab. And thank you for joining us today as we head into the weekend. Kind of a crazy week here. Just tell me, how are you seeing the markets right now?
So it's interesting to think that we're, within a stone's throw of all-time highs when the volatility we saw at midweek just, I think shook the markets a little bit, whether it was the Fed minutes pointing to higher for longer or, even some Fed governors wondering if we're restrictive enough. And then, you have the PMIs that came in a little bit hot. And then right along with that, you get a moonshot earnings announcement from NVIDIA, which kind of set things straight again. So a lot happened in the middle of the week. It kind of feels like we trickled off a little bit into the weekend, but it's a lot for the markets to digest and a lot for traders to digest.
Yeah, and Joe, just to put things in perspective for us as well, because as you mentioned, we kind of trickled off into the weekend. It's a holiday weekend. We're going into the summer season. Do weird things happen on Fridays in summer? It feels like, volume's thin, and so there's sort of some mysterious market movements sometimes. Yeah,
no, they can. One thing I noticed for sure from my old option trading days is that the Friday going into a long weekend, you tend to see the VIX come down a little bit. We saw that today, trading back down around 12. That's just because option traders don't want to hold the extra day of time decay over the weekend. So a lot of times you see volatility compress on the Friday before a long weekend. What that also can mean, as you mentioned, is you can see declines in volumes, and when there's declines in volumes, that means bid-ask spreads tend to widen out, which means that you can see some movement. And what's interesting to me, kind of given the week that we saw, is like I said, even with all the volatility we saw midweek, there's really only maybe one sector, and that's tech, that had a good week. Tech was up over around 1.75% to 2%. But for the most part, the only other sector that was unchanged was industrials. Everything else was down in the week. And then if you look at the indices themselves, Dow was down quite a bit. I mean, a lot of that's off the Boeing announcements. But then you saw the Russell having a hard time holding pace as well too. So there's a lot of churn under the surface right now. A lot of that kind of gels with what we've seen from our trader survey in terms that, they're not feeling as bullish as they were in Q1. I think there's a little bit of, I don't want to say trepidation, but at the same time, a little concern, right? A little consternation as we kind of move into the summer months. And I think part of it is, it's really twofold. It's the inflation data that we got back in April that proved hotter than expected from the CPI to the PPI, and then also kind of what we're seeing from market valuations. Even though earnings were really good, we had an 80% beat rate, we're still a little bit light on the revenues. And it's the guidance going forward that I think is maybe giving investors a little bit of a pause.
So what do you think the next catalyst is? We got some earnings reports still trickling in. Next week we have PCE, but if you read CPI and adjust the weightings, you can kind of figure out what it already is. What do you think moves the market next?
Yeah, no, and I think it's a great point that you just alluded to there. I think one of the differences between the CPI and the PCE is going to be that housing component. The CPI's got a much higher weight of that housing component built into it than the PCE does. So, if the expectations of that sticky inflation on the services side has been holding up that CPI, really from housing, then the expectation should be if you pull that out, maybe not to the same extent in the PCE, maybe you're seeing a little bit of a move more towards that disinflation that I think the markets are hoping for. But really, yeah, the catalyst is going to be interesting because like I said, we are close to all-time highs, but what's going to be that thrust to push us back up? I think NVIDIA definitely helped this week, but there's really nothing outside of maybe, Salesforce, Costco you might look at next week in terms of to see kind of what the consumer's doing. I think that's important because we keep hearing this narrative that consumers are getting strapped and that they don't have the same cash that they did before. And are they still spending? Are they moving down, right, in terms of what the products that they're buying? I think we started to see that. But then the durable goods number today, showed that it was higher than expected. But even when you look at the durable goods, that wasn't a clear sign because we had revisions back for the last number. So it's a lot of this kind of choppy back and forth data, whether it's the soft data that's coming in less than expected, but the hard data is kind of holding firm. So I think there's a lot to digest. And that, to me, once again, when I look at that trader survey, that makes a lot of sense to me because there's just no clear-cut path right now.
Well, Joe, one of the catalysts that's been pretty consistent has been this AI enthusiasm as evidenced by NVIDIA this week. And I thought it was interesting that in your survey, the traders think that AI is crowded, the trade is crowded, but they still like it.
Yeah, no, and I think that's such a key point because this trader sentiment survey, it's a survey, so it's attitudinal. But then we also have the Stacks report, which I talked to you guys about earlier in the month, and the Stacks report is the behavioral version of it. So what are they doing versus what are they saying? So even though they might say that, hey, that seems like an overcrowded trade, the three stocks that they bought the most heavily in that April cycle were AMD, NVIDIA, and SMCI. So what happened between those three names? NVIDIA pulled back 10%. They used that as an opportunity to buy the dip. AMD and SMCI were both down around 20%. They used that as an opportunity to buy the dip. So while they might be saying it's overcrowded, they're looking for opportunities. They're picking their spots, and they're being very discerning in when they go ahead and buy those names.
Joe, good to see you. Have a great holiday weekend.
You too. Thanks so much.
Thanks. That'll do it for today's Market Domination Overtime. Be sure to come back Tuesday at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's the latest edition of our new show, Asking for a Trend. Stay tuned. welcome to Yahoo Finance's brand new show, Asking for a Trend. I'm Julie Hyman, filling in for Josh Lipton. And for the next half hour, we'll be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we are watching. The focus now back on the Fed. Investors higher for longer fears outweighed NVIDIA's blowout report this week. The S&P 500 barely gained ground on the week, while the tech-heavy Nasdaq did hit a fresh record high. Plus, from Wall Street bets to Washington, retail investors are cashing in by replicating trades made by public figures. More on copy trading next. And the deal is back. Burger King's $5 value meal is back, the latest attempt by a fast casual chain to woo inflation-weary customers. Well, if you're looking to outperform the market, forget Wall Street. Maybe look to Washington. Last year, several politicians, including Nancy Pelosi, Susan Collins, and Richard Blumenthal, they beat the S&P 500 returns in their personal portfolios. If only it was as easy as copying their trades, right? Well, actually, it is. It's literally called copy trading, and Dub is one of the platforms that's making it possible. Founder and CEO of Dub, Stephen Wang, is joining us now with more on that trend. Hey, Stephen, thanks for being here.
Thank you so much for having me.
So, copy trading. Now, it's interesting because on Twitter, I see people all the time talk about Nancy Pelosi's portfolio or what have you.
Yeah.
But now, like, how does it work? You just click and you say, I want to follow Nancy Pelosi and trade, like, do the same thing.
Absolutely. So we're a brokerage similar to Robinhood or Schwab. So you can open a brokerage account with us and you can scroll through portfolios. And portfolios are a basket of stocks, very similar to ETFs. And these portfolios are trading different themes and strategies. So we've got people who've made portfolios that are copying politician trades like Nancy Pelosi, or even hedge fund managers, and also just really good traders that you can copy. And instead of really picking stocks now, you just pick a portfolio that you want to invest alongside with. The same way you'd invest $10 in Tesla, you can take $10 to copy portfolio. And after you started copying one, every trade that's made by the creator of the portfolio, you automatically get. So it's really bring this idea of, hey, if you don't really know how to navigate the markets, you can now trust someone. And it just happens to be so some of our hottest portfolios are copying and tracking the trades of Nancy Pelosi, who's up actually on the platform 55% this year annualized.
Yeah, well, I was
nuts.
going to say, so you can see the history of how these different folks have done.
Yes.
And make your determination not just based on who it is,
Yep.
but what their performance has been.
Absolutely. And the whole idea is we want to bring more trust and transparency to the system. So we've seen not just Nancy Pelosi, that's one of the recent trends of politicians, but also the meme stock craze 2 weeks ago and this past week, the 1.0, even star fund managers like Cathie Wood. And this really goes to the theme that I think we're seeing in the markets broadly of Gen Z, millennials, and the younger generation of retail traders. It's no longer about sitting behind a bunch of screens and looking at the numbers. It's about following people and ideas. And that is where the puck is going. We've already seen it happen with the meme stock craze starting in 2020, this idea of the influencer economy really coming to investing. And that's the vision of Dub. It's beyond copying just politicians, which is a small part of it, but really building this social investing platform that productizes this completely new consumer behavior that we're seeing.
So who are some of the most popular people on the platform?
Yeah, so we've got a hedge fund manager from a former Millennium hedge fund manager who's trading the Nancy Pelosi portfolio, and he's using his quantitative algos to actually model what Nancy Pelosi's trades are. There's actually not just what Nancy's doing. And Nancy's actually very hard to replicate for regular retail investors because she's doing a lot of options, shorting, and that may not be really accessible to large population. We've also got one of our most popular portfolios is recent Bitcoin. So we've got a quantitative algo trading Bitcoin, and it's built to better manage risk. AI is another really hot trend. And we've also got some really incredible investors that are popular on like Seeking Alpha and Twitter or X, and they've already built large followings, and they've come on to Dub, and they are now managing hundreds of thousands, aggregate millions of dollars now on the platform, and just retail people that really believe in what they're doing. And that's what we really want to empower. And this is a shout out to just any talented investor out there. One of the core fundamental visions of what we want to do is build a platform where you don't need to be in Wall Street and spend millions of dollars in years to launch an ETF or hedge fund. In 5 minutes, you can make a portfolio and you can be copying or getting copied by other people.
I'm going to play devil's advocate for a second here, because it just so happens that I just watched an opinion piece from another finfluencer, I guess you could call her, Kyla Scanlon, who is a commentator. And she cites, ironically, since I would call her sort of a finfluencer herself, she cites a recent study that showed that finfluencers don't actually do very well. And so the people who follow them don't actually do very well. And so how do you sort of correct for that, this sort of cult of personality? Like what are the risks of mixing the cult of personality with investing?
You know, I saw that same piece, and that is what Kyla said is actually fundamental to Dub's thesis of driving trust and transparency in the system. You're actually totally right. People, I saw it just based on the latest numbers from the meme stock raise, even last week, people lost $13 billion on the GameStop and AMC crash down. So how do we prevent that? And with Dub, we're bringing sort of a validated real track record. Since we are the brokerage, it is important to note that we're actually the only regulated platform in the United States to offer copy trading. We're a broker-dealer, member of FINRA, and regulated by the SEC. And that holds us to a higher bar and standard for really making sure that when someone comes onto Dub, you're seeing the actual trades that they've made. You get to see their actual track record, and we are validating what they've done. So if you go on Twitter today, they could Photoshop some image or they can post about some stock, but you never know if that's true or not. So it's almost, we hope in a couple of years from now that, hey, if you're a influencer and you're not on Dub, that's going to be an issue because you're maybe afraid of hiding the truth, right? If you're good at investing or not. And that is to Dub's ethos of, hey, we really want to bring trust to the system.
Stephen, great to meet you. Thanks for coming in.
Yeah, thank you so much for having us.
Yeah, of course.
Thank you.
Well, coming up, before you log off for the holiday weekend, we've got what to watch for next week on Asking for a Trend. Time now for what to watch next week. Kicking off with earnings, a slew of retailers set to report their quarterly results. On Wednesday, investors can expect to hear from American Eagle as well as Abercrombie & Fitch. On Thursday, we'll hear from Birkenstock, Dollar General, Best Buy, Gap, and Costco. Investors will be watching Costco for what the company says about demand, consumer spending, and the impact of gasoline prices. Other earnings on deck include HP, Salesforce, and Dell. That stock, by the way, hitting a record high on Friday. And turning to economic data, an update on consumer confidence in store for Tuesday morning for the month of May, while investors can also expect more Federal Reserve commentary. Cleveland Fed President Loretta Mester and Minneapolis Fed President Neil Kashkari will deliver remarks next week ahead of the Federal Reserve's Beige Book. Meanwhile, on Thursday, the central bank will keep an eye on revisions to estimates of first quarter U.S. gross domestic product. Then, to wrap up the week, the Fed's preferred inflation gauge, personal consumption expenditures, will be out ahead of the open. Well, stick around. We've got more Asking for a Trend on the other side. are wrapping up what was an action-packed few days here at Yahoo Finance as we head into a long weekend. We wanted to leave you with an encore presentation of our latest video series. Next, Madison Mills takes a glimpse at the future of AI. Enjoy and have a great holiday weekend.
Hey Rodney, I'm Madison. It's really great to meet you.
This is Rodney, and he's living with amyotrophic lateral sclerosis, or ALS, a disease that gradually inhibits all movement, including your ability to communicate. But Rodney has a special technology implanted in his brain. It takes signals from the brain and translates them into commands on an external device, like computer keys. In other words, it reads his mind.
Was it scary to be the first person to get the stentrode? Not really. That's cool. That's pretty brave.
But he's talking to me right now, all the way from Australia, thanks to the stentrode, an AI-powered brain-computer interface developed by Synchron, a neurotech company backed by Jeff Bezos and Bill Gates. This may sound familiar, as Elon Musk is also working on Neuralink. The company introduced the first patient to receive its implant.
It was like using the force on a cursor.
The stentrode and Neuralink are both examples of BCIs that are implanted inside the body.
But according to experts, the next big innovation in the space is portable products that live completely outside of the body, like this.
This spectrum of devices falls under the umbrella of neurotechnology, which is any technology used to either record signals from the brain and translate them into technical control commands or to manipulate brain activity. Neurotechnology is on the agenda for big tech companies like Meta and Apple, and AI is speeding up advancements in neurotech, which can be empowering for patients, but as the tech becomes less invasive and more accessible for everyday consumers, it could put our most valuable data, our thoughts, at risk.
This is our final fortress of privacy, and we've given up every other aspect of privacy that exists.
After first-of-its-kind neuro rights legislation was passed in Colorado, experts and activists are working to make federal policies about our thought data.
This is what's next in neurotechnology and data privacy. Meta is funding a team of neuroscientists who are pushing this field of research even further by using AI to understand how humans process language. The company says the goal is to help people who've suffered traumatic brain injury to communicate.
We did a research where participants watch images in a neuroimaging scanner, and the goal is to train an AI system to reconstruct what they see solely from brain activity. And what's surprising is that it works much better than what we anticipated.
Volunteers sat inside a magnetoencephalography, or MEG machine, which measures the magnetic field generated when neurons fire. Over the course of several hours, volunteers viewed each image for 1.5 seconds, and the AI system learned those MEG recordings. This is the image that was flashed in front of participants, and this is the image that the AI scanner was able to recreate.
And so you can see that the images on the right are never quite accurate, but still it does capture a lot of semantic properties, like when it is an animal, it tends to be an animal. And that suggests that these magnetoencephalography signals, this brain signal that can be captured in the lab, can be used to recreate the image that they perceive. The first reaction was, okay, there is something, we must have leaked some training data in the test sets. That was my first reaction. Okay, let's try to find where we could have had some bugs that could explain the quality of these results.
So you thought they were so good, there must have been a bug?
Yeah.
When I look at these images, they did such a good job. It looks really good. So it makes me wonder, like, is this a mind-reading technology?
So this is not a mind-reading technology at a given instance. What we can try to do is reconstruct the image that they see at the given moment. So we're really decoding perception. What has been shown in other research is that trying to decode what people think at a given instance on their own without being triggered by something is actually much, much harder.
In regards to the relationship with Meta, does that impact the outcome of any of the research?
So the goal of our research is not to have a product down the line. This is a research which fits a portfolio of research projects at Meta. The goal is really to figure out the key principles of intelligence and what makes humans so able at learning things extremely quickly.
His team is part of FAIR, which stands for Fundamental AI Research. Meta has been studying how AI learns language since before the company changed its name. That F in FAIR used to stand for Facebook. But the team is not attached to any medical or academic institution. King stresses that consumer-facing products are not the end goal of his research. At the same time, Meta is continuing to work on consumer neurotech.
I think we'll start getting some consumer neural interfaces soon. I'm not talking about something that jacks into your brain. I'm talking about something that you wear on your wrist that can basically read neural signals that your brain sends through your nerves to your hand to basically move it in different subtle ways that are maybe not perceptible to people around you. But we're basically able to read those signals and be able to use that to control your glasses or other computing devices. And I think that's going to be pretty wild.
Since 2021, Meta CEO Mark Zuckerberg has touted an armband that sends
these like nervous system signals to your muscles, and you can actually pick those up with an EMG wristband.
EMG measures muscle responses or electrical activity in response to a nerve stimulation of the muscle.
They have a prototype of the wrist device. It's something that they're investing heavily in with Reality Labs. Billions of dollars go towards that. They are making progress in certain areas, whether it's their AR, VR efforts or these kinds of efforts that will eventually feed into what Mark Zuckerberg sees as the future, if not necessarily of the metaverse, then of technology.
In 2022, Apple filed a patent for AirPods that use electroencephalogram, or EEG technology. The proposed earbuds could contain over 24 electrodes that are configured to measure biosignals and electrical activity of a user's brain.
I think in-ear EEG is going to be much richer data than EMG on the wrist for brain health and wellness, which is a huge potential market. When it comes to the products that are on the marketplace right now, are they over-promising or are they accurately, to a degree, with some noise, reading our minds? Or are they actually decoding, like your private ruminations, like you're thinking about what am I going to make for dinner? Those kinds of things aren't being decoded by these today. What they're decoding are basic brain states that can be averaged across the entire brain. So things like, are you sleepy? Are you paying attention? Are you stressed? Basic emotions, are you happy or sad? Those are metrics that can be picked up. And in some ways, that's mind reading, right? It's still revealing things about your inner states, but it's not the kind of robust thoughts, which isn't to say that isn't possible. It is to say that none of the consumer-based EEG devices that are on the marketplace can yet do that.
According to one estimate, the neurotech industry was valued around $15 billion in 2023 and is projected to reach over $55 billion by 2033. This comes as AI has fueled earnings growth for the biggest tech companies. Tech giants like Alphabet, Nvidia, and Amazon have all seen double-digit gains this year following increased AI investment. As AI-powered technology accelerates advancements in both medical and consumer-facing neurotech, one analyst says investors should look at companies that are prioritizing privacy.
If you can monetize that data safely, that would be a great play for a lot of people. If you actually provided the right product and service.
I think people just don't understand what it means to live in a world of complete brain transparency. The one space we have for mental reprieve is really, our brains and mental states. It's the kind of final piece of the puzzle.
Dr. Rafael Yuste is a professor of biological sciences and neuroscience at Columbia University. After years of research, he discovered a way to control the thoughts of mice using lasers.
This was actually my Oppenheimer moment, but at the same time, I felt whatever you can do in a mouse today, you could do in a human tomorrow.
He basically did Inception in real life, and it scared him so much that he started the NeuroRights Foundation, which says it works to protect people from the potential misuse or abuse of neurotechnology. The foundation recently evaluated the privacy practices of 30 major consumer neurotech companies, selling a range of devices, including headbands, bracelets, and glasses for activities like sleep, meditation, and gaming. Upon reviewing the consumer user agreements, the foundation determined that
30 out of 30 companies takes possession of all the data of the user.
This is not dissimilar from most privacy agreements that users are familiar with, which allow tech companies to collect your data. The difference is these companies are collecting your neural data, and Dr. Yuste says that could warrant additional privacy protections. The study found that over 66% of neurotech companies' policies mention they can share data with third parties, while 30% of companies are unclear on the matter of data sharing.
That third party could be a company, could be whoever they want. They could be a foreign agent. So from our point of view, this is not okay.
Over half of the companies included don't even mention neural data in their privacy documents, making it unclear whether that data would be protected.
The current regulation of commercial neurotechnology is being treated as consumer electronics.
Take Apple, for example. According to the company's privacy policy, personal data is any data that relates to an identified or identifiable individual, or that is linked or linkable to them by Apple. This includes data like your email address, location, bank details, and search history. Products like the Apple Watch can also collect your health data, like your sleep time, heart rate, and respiratory rate. But at no point in Apple's privacy policy is neural data mentioned. That AirPods patent came after CEO Tim Cook announced the company's focus on healthcare.
I believe if you zoom out into the future and you look back and you ask the question, what was Apple's greatest contribution to mankind? It will be about health.
Health data that can reveal a lot about an individual, but also generate a massive amount of personal information.
When they can correlate all of that information with the in-ear EEG data, suddenly they have a treasure trove of information to not have you just close the circles for, how many steps you've taken a day or how physically active you've been, but your stress levels and your cognitive fitness to really correlate what's happening in our brains with all kinds of neurological disease and wellness kind of metrics.
Neurorights advocates say advancements in neurotech in recent years require urgency in the form of immediate regulation to protect our privacy and brains from being hacked, manipulated, and attacked. The Neurorights Foundation developed a framework for potential neurorights policy focused on mental privacy, personal identity, maintaining free will, protection from bias, and fair access to neurotech for those who want it.
We want to develop neurotechnology. We think it's good for humanity, but we want to do it in a responsible fashion. This is about responsible innovation.
Innovation that could already be helping people, at least according to Synchron.
There's millions of people, almost 8 million people here in the United States alone that have some type of motor impairment where it becomes real challenge to use devices that we take for granted every day. Like everybody walks with a phone. Technologies like this can really start to aid for those that can't do that.
Even if it's tiring, has the device made communicating easier for you overall? Yes.
I think that's the one thing that people really don't understand is that this is not like 20 years out. It's not even 10 years out. I think we're in a shorter timeline than that.
For Farahani, the speed of innovation requires quick policy action. Her framework favors a broader approach that argues for more privacy overall, with a right to self-determination over our brain and mental experiences.
That would give people a right to be able to both access and use the technologies if they choose to do so, a right to mental privacy as an explicit part of the right to privacy. And that would mean that we'd have a right against interception and interference with even the automatic processes in our brains, and then a much more robust right to freedom of thought. And I think of thought as like really the mind reading stuff, right? It's like what you're thinking and feeling, and being able to have a right against the interception, the manipulation, and punishment of those thoughts.
Regulators and governments are beginning to take action on this. With the help of Dr. Yuste, in 2021, Chile became the first nation to amend its constitution to protect the right to mental privacy and free will. Mexico and Brazil have also proposed constitutional amendments for neurorights. Domestically, Colorado passed a bill that expanded the state's Privacy Act to include neural rights, the first of its kind in the U.S. Similar legislation is on the table in states like California and Minnesota.
What is your biggest hope for what this industry looks like 10 years from now? My biggest hope is that it is a tool of empowerment for individuals, that people have really the ability to control their own data, that we have a system of trust and rights that strongly favor individuals and their right to cognitive liberty, and they're able to use the insights to improve their brain and mental experiences, their mental well-being and mental flourishing.
What do you hope the device will accomplish long term? Hopefully it will get to more people.